Roar here with the aftermarket analysis for Wednesday, October 2nd, 2013 for the foreign exchange. And yet, as we noted in our equities and fixed income analysis and outlook video, we have deferred this until Thursday morning, October 3rd. It is currently 8:15 a.m. Central Time in the U.S., and that was in order to include any of the extended response to the failed attempt to negotiate a way out of the U.S. government partial shutdown and achieve some sort of agreement on a continuing resolution for the U.S. budget, and Mr. Obama's bringing together the heads of his democratically controlled Senate and the opposition's Republican-controlled House were actually a big lot of nothing, because all sides to this negotiation, such as it was, signaled they had no latitude to actually compromise to any degree, especially on the part of the president and the Democrats, which is not to apportion blame. It just happens to be their position right now after quite a bit of recalcitrance by the Republicans on entering into negotiations over the summer, that there would be nothing less than what is known as a clean. In other words, no amendments to change any other legislation, such as the Affordable Care Act. There would be nothing less than a clean continuing resolution, simply agreeing to fund the government before negotiation on any other matters would be entertained. And what is a bit more scary is the degree to which they meaning the parties on both sides, become so entrenched, it's starting to feel a bit like the summer of 2011. Meetings don't matter unless there is actually room to compromise. Intractable positions being restated up to and maybe after the point, in this instance this week, of the continuing resolution to fund the U.S. government, which is a failure of sorts already. It means you haven't passed the budget, and they haven't done so for 5 years now. And more critically and potentially damaging would be the inability to compromise and pass an increase in the U.S. debt ceiling by sometime around the middle of October. So here we are, and what are the implications for the markets? And so far, the markets are taking this in stride, under the presumption failure is not an option and something will be worked out. Unfortunately, that was the same psychology which prevailed out into the summer of 2011 through the end of July, which landed us with that catastrophic failure August 1st of 2011. Now, the actual market implications, we can look at the U.S. dollar index and see, in this case, due to the fact, the problem that is weighing on the equities, which is now spread a bit to the other equities outside of the German DAX, that is also weakening the U.S. dollar. Now, this is somewhat atypical in most cases. Equities weakness, speaking of potential for global economic weakness, often weakens the other currencies from the so far less dramatically improved economies than the U.S., which even in its own right is only improved to some degree. But when the source of the problem is so blatantly the U.S., then the dollar can suffer as other currencies strengthen, which our regular viewers and readers know has been our position for the last several weeks or so. So the initial U.S. dollar extended sell-off that started with the summer's withdrawal, meaning more accommodative Fed, summer's withdrawal from the race for the Federal Reserve chairmanship, exacerbated by the FOMC surprise back on Wednesday the 18th, with the no taper right now indication, has left the dollar testing a level we had expected for a while, down around 80 even, which it most certainly did not get to on the mid-June or mid-August sell-offs. And it is even eroding a bit below it, but that has support into congestion, maybe down around the 79.5 area or so. Much below that, it might have to revisit at a minimum the 78.60 low, which was seen back in mid-September of last year. And the indications, trend indications, are weak, and the worse the crisis gets in terms of the lack of current government funding and potential for no compromise to raise the debt ceiling, the more so the dollar might suffer. And again, as you can see, the trend indications all look lower. The opposite is true. The heavily weighted euro is seeing that the Europe, along with the UK, is strengthening against the US and has pushed up into, initially on the FOMC surprise, pushed out above its 133 to 133.5 resistance that it struggled with back out of August, mid to late August, and has further resistance, though, up at the peak of this nominal, very suspect, broader head and shoulders, which was already failing to perform when the market failed to stay on the down breakout below 128 even area back in early July. And this was on another indication of U.S. accommodation that strengthened the euro and the other currencies against the U.S. dollar, pushing up after only stalling temporarily and not reacting below the 134.5 area. The market basically is entitled to at least test and very possibly exceed 137.11, but with further resistance waiting up in the mid 138s and especially up in the 140 historically. But here the indicators are all up, as they are in the British pound against the US dollar. So a very interesting picture, where we didn't bother to revise this Fibonacci level yet because the retracement would still be somewhere down into the 158.5 to 159 area at worst. If the market shows a bit more topping tendency, we will be tending to that. But for now, the pound being out above a Fibonacci, a oscillator band at about 5 points over the 41-week average, only reinforces the degree to which the rally above 157.5 classically has only interim technical resistance or support around 160, and is more likely to see 163 to somewhat above it. Best case of the last year and a half has been the temporary spike up to 163.79 into the first of the year this year. So indicators remain up here as well. Now the Asian shift shows us that where the Australian dollar certainly was very encouraged by the Fed lack of tapering going back a couple weeks ago, it managed to escape to the upside, and it was already acting pretty well from the week before into early that week, as it should have stalled right around the 93 even level to slightly above it, and it was straining out above that, which also meant it was remaining above the 92.80 Fibonacci resistance, the initial 25% resistance of this major downdraft from the last hurrah high up in the 106 area back in April, and was also breaking up out of a channel from 92.40 area. So we have pegged 92.80 to 40 as support, and as you can see on the pullback into early this week, the market indeed held right against the top end of that, and it's going to be interesting to see if it can indeed push up further, because that would rescue it from this very minor downward signal on the daily MACD, where the weekly MACD remains very much in an upward consideration ever since it turned up on the recovery from the retest of the the 89 area going back a month or so ago. Now, what's interesting about this is the degree to which it's also up against an important oscillator support right around 5 points under the 41 week moving average. So here we are at 4 under, so the degree to which 5 under would be another point lower. We're at 94 right now. This reinforces the degree to which the 93 area is going to continue to be important support, not just on these Fibonacci levels and breakouts, but on the key to the market not putting in an attempted reacceleration downward by failing oscillator support. Shifting over to Japan, the yen strengthened this week. This might have had something to do with Mr. Abe's announcement that they will indeed be going ahead with their sales tax increase next year, and this is to offset some of the fiscal imbalance caused by the massive stimulus program, which the Bank of Japan and Ministry of Finance have put through, and this was grounds to see the yen strengthen in any event. And it is interesting, is now failing in a more sustained way out of this last up break above the 99 area on the weekly chart, and seems to be maintaining the down break from about 98.80 on the daily chart. And that's important because the daily and weekly MACDs being down, and the market now having a key Fibonacci level around 9,700, which of course it got very near at the low yesterday, is in a critical state where maybe, as is often the case, pushing out above a triangle downward trend line, which had gone too far into the apex, gives the false breakout first in the wrong direction, and then can revert to the true breakout and failure. And that's where the 41-week average is going to loom large. It's about 96.60 now, but due to the strength of the overall uptrend, is coming up approximately 35 points a week. So it's also going to be right in the 97 even area next week. So we'd keep a close eye on that. If that fails, even though there are these interim lows right around 95.60 area from the sell-off back in early August, chances would be better the market needs to go in for a bit more of a correction. And it's interesting that the Fibonacci area down here at 93.5 was neared at the low of the break back in June, and that also would now represent significant channel support. So 97 is a key support this side of potentially something like 93.5 to 94 being tested once again. And looking at how that works out on the cross rates with the yen and the euro both firming, this is in a little bit of limbo right now, but still, after the cleanouts out of early this week, the 93.50 area, I've got 93 on the brain here, 132.50 area, which was the top from back in May, which the market struggled with for months, still remains an area where the market should be looking to push higher. Even though it's sunk below the daily averages this week, you'll note the weekly averages are in the mid to low 131 area, as is the weekly trendline support. So we think this market will probably have to be back below 131, which it never quite got to on the lows this week. Much below that, we might be looking at a market that is failing out of this up break, and at that point would be well back below this major 50% retracement in the 132 area. But for now, need to give the euro the benefit of the doubt against the yen, and looking at how the euro is doing against Australia. Once again, they're both strengthening, so it's a little bit of a limbo the market is sunk into right here around the 145 even area, but that's going to be very critical because it is kind of the down break out of the channel they keep leaking out of but can't stay down. And of course, low 145s are key weekly average levels. And there is the battle right now between the modestly negative weekly MACD that's been in that state for a couple of weeks now and a daily MACD that wants to say it's turning up. But if the market should fail, and that would likely at this point mean back below the previous congestion and current congestion in the mid 143s once again, that would probably turn daily MACD down and violate daily average support, where weekly averages had already stalled the market. Much above 145, it reinforces the daily indicator strength and tends to give a more clear signal that the weekly averages are being exceeded again, which would put in a sense of a likely retest of the highs, if not indeed even better levels. And last but not least, with the euro catching up a bit of late to sterling, this latest attempt to accelerate down out of the bottom of its gradual channel in the 83.5 area obviously is not succeeding for now. With last week's close at 84.5, if this should continue to strengthen, in spite of the churn of the last several weeks and inability to get much traction on the upside previous, note that the daily MACD didn't really turn back down so far, and that we have downward channel resistance. There's a split channel depending on how you put it through, and that's into the 84.5 level. So along with this Fibonacci level, which is right in the low 84s, if this market should get above the 84.5 level by any degree, it's probably signaling that it's based for now and could turn up in a more meaningful way. And that is pretty much it. Hope you've enjoyed the discussion. We're going to return to a quick look at the dollar index. Still weak, but probably only gets more conclusive on the downside below 79.5, and that would be consistent with whether the equities weaken further and more of the trouble that is plaguing the markets right now flows out of this intractable confrontation in the U.S. that starts to smack of a potential problem, not just for government funding on the current budget, but the debt ceiling negotiation and confrontation that is brewing for the middle of the month. Bye for now.